Let's get to the heart of the matter with the presentation of the first solution to get out of the crisis. 100% money. Solution 1. 100% money. Should commercial banks have the power to create or destroy money? Let's study the current fractional reserve system and its dangerousness. Let's look at the case of a bank with capital that has the right to lend part of it to Mr. Durand. Mr. Durand signs a loan contract with interest, an acknowledgement of debt, and his account is credited with the borrowed sum. In reality, the bank does not lend his capital. As soon as you deposit, say, 1,000 euros with the bank, subject to covering 10%, 100 euros of the reserve requirement, can create 900 euros of change out of nothing and credit Mr. Durand's account with these 900 euros. 900 euros created out of nothing on Mr. Durand's account by signing an acknowledgement of debt. What happens in the case of the fractional system with successive deposits and loans? Let's imagine Monsieur Durand depositing 1,000 euros in the bank. The bank has to keep 10% of compulsory reserves and can lend 900 euros. Michelangelo, the painter, needs 900 euros to buy his canvases and brushes. He signs a loan contract, an acknowledgement of debt, and this currency is credited to his bank account. Let's look at the bank's monetary balance sheet in the first stage. The bank holds 100 euros in compulsory reserves, the initial 1,000 euros, and the 900 euros in loans granted to Michelangelo. So, a total of 1,900 euros of currency in circulation. When Michelangelo deposits this currency in the bank keeps 90 euros of change in compulsory reserves and can grant a new loan of 810 euros. Jean-Paul, the bricklayer, needs 810 euros. He in turn signs an IOU and his currency is credited to his account. Let us look at the monetary balance sheet in the second stage. The bank's compulsory reserves are 190 euros, and the total bank deposits are 2,710 euros of currency in circulation. Jean-Paul will deposit this money in the bank. Once again, the bank will keep 10% of this amount in compulsory reserves, and can grant 729 euros in loans. Sophie takes out a loan. She signs an acknowledgement of debt. Let's look at the bank's monetary balance sheet at the end of the third stage. There are 271 euros of required reserves for a total deposit of 3,439 euros. At the end of 3 stages, there are 3,439 euros in currency in circulation covered by only 271 euros in reserves at the bank. In the event of a crisis of confidence, this lack of bank cover can lead to the bankruptcy of commercial banks. Indeed, depositors would only be able to withdraw 271 euros of currency that actually exists in the bank in relation to the total of all depositors' deposits of 3,439 euros in the third stage. We have just seen in the previous example that a large proportion of bank deposits are not covered by currency. 100% money is the idea of covering the current accounts of the depositors with real currency. In other words, all bank sight deposits are fully covered by currency. This means that if everyone withdrew their current account deposits at the same time, the bank could serve all its customers in real currency, thus preventing any bank run. Any bank account would be fully covered by currency at the bank. This would ensure banking stability with much lower risks of insolvency and bankruptcy in the financial system. By imposing this measure, states, through their central bank or national bank, could inject currency to raise reserve requirements from 10% to 100% on all current accounts of households, but also of private companies. We can envisage two scenarios. The first, with initial reserve requirements of 10% at the bank and the blue part of uncovered demand deposits, covered in 100% money by real currency. In the second scenario, the 10% initial reserve requirements of commercial banks are released and the uncovered sight deposit accounts of depositors are fully covered in 100% money by real currency. This is not a nationalization of commercial banks. Commercial banks will have two distinct compartments. Sight deposit accounts covered 100% by real currency and investment accounts. This does not mean banning credit either. It simply means prohibiting the lending of currency from depositors in sight deposit accounts that are fully covered by currency. Ultimately, 100% money means the abolition of the privilege of currency creation by commercial banks. Full currency coverage of demand deposit accounts is not a gift to commercial banks. The first possibility would be the exchange of central bank currency for the purchase of assets. The monetary replenishment of the totality of commercial bank demand deposits by the European Central Bank, or by the National Bank, is exchanged for government or private company bonds. A monetary issuing committee (MIC) would be set up with the task of issuing the money needed to fully cover overnight deposits. But it would also be used to exchange currency for government or corporate bonds. The central bank currency issued by the MIC would cover demand deposits of commercial banks. In exchange, commercial banks would cede government and corporate bonds to the MIC. A very important point. In this exchange, there would be no increase in the mass of currency in circulation and therefore no inflation. There is a second possibility, interest-bearing loans against central bank currency. The monetary bailout of all commercial bank demand deposits is exchanged for the contraction of commercial bank loans with interest. MIC would hold debt securities on these loans to commercial banks. As monthly repayments are made, MIC would purchase government bonds held by commercial banks. Again, there was no increase in the currency supply in circulation. In fact, 100% money prohibits commercial banks from creating currency through credit. 100% money has many advantages. Virtually no more bank panics and rushes to commercial banks in the event of a crisis of confidence because of the full coverage of depositors' sight deposit accounts. Far fewer bank failures. No need for a frantic liquidity race to guarantee the reserve requirement ratio as before this system, which means less insolvency and therefore less risk of bank failures. There would no longer be any ambiguity about the ownership of currency in banks. The currency in sight deposit accounts would legitimately belong to the depositors. Currency in investment accounts would belong to the bank for the entire time it is invested. Large inflations or deflations would disappear for the good reason that banks would be deprived of their current power to create or destroy currency in deposit accounts through credit. Finally, government debt would be substantially reduced. Unsubstantiated objections and fears of the 100% money system. First, let's look at the misconception that the 100% money system is inflationary. Whether by exchanging central bank currency for bonds or central bank currency for loans with interest, there has been no increase in the mass of currency in circulation. Existing sight deposits made up of imaginary currency have been changed into deposits fully covered by real currency. The money-issuing bank could regulate the amount of currency in circulation by buying government bonds in the event of deflationary risks. It could reduce it by selling government bonds in case of inflationary risks. Its role would be to maintain prices and the value of the currency. The second misconception would be that bank loans would be more difficult to grant. Commercial banks could lend their own capital, lend the currency they receive from investment accounts, They could also lend the currency from the monthly repayments of outstanding loans. Effective implementation of 100% money. The contours of the law and the status of the Monetary Issuing Commission. Article 1. The government authorizes the MIC to issue a new quantity of currency and to use this new quantity of currency to purchase from all commercial banks holding demand deposit accounts sufficient government bonds to provide these banks with full coverage in real currency on all the demand deposit accounts they hold. Article 2. Monetary creation by commercial banks is prohibited. Currency on sight deposit accounts fully covered by currency may not be used to grant loans, and consequently revert to the fractional reserve system. Sight deposit accounts and investment accounts are ring-fenced. Any substitution of currency on overnight deposit accounts is prohibited, and any circumvention of the law for currency creation purposes is also prohibited. Article 3. The MIC will be equipped with software to monitor in real time the currency coverage of all demand deposit accounts of all commercial banks. Any violation of the 100% money reserve requirement on demand deposit accounts by a commercial bank will lead to the freezing of the banking operations of that bank until the demand deposit accounts regain their full coverage. A fine in an amount significantly higher than the profit of the commercial bank that circumvents the law will be imposed. Article 4. The government authorizes the MIC to manage the currency in circulation to be fixed per capita or to maintain a fixed purchasing power. In order to do so, it has the right to sell government bonds in the event of too large an increase in the currency supply. It has the right to buy them in the event of a contraction of the currency in circulation. That is, in the event of deflation. Transition. The transition from the current system to the full coverage system. It will be very simple to implement. There will be no impact on commercial banks' relations with their customers at the level of day-to-day operations. Finally, there will be no disruption of financial flows in the economy. Estimated orders of magnitude for government debt neutralization in billions of euros. In order to estimate the orders of magnitude for the neutralization of public debt, it will be necessary to analyze the amount of overnight deposits to which can be added other monetary deposits with a period of notice of 3 months, or less, and those with a period of notice of 2 years or less. For each more or less liquid monetary asset, a range, an estimate. A high and a low range are defined as a percentage of what the quantity of currency needed to switch these assets to the MIC could be. The components of liquidity transferable to the MIC are as follows. Demand deposits are fully transferable. Term deposits with fixed maturities of 2 years, or less, with an estimated range of currency required to transfer these assets of between 20 and 30%. Interbank refinancing loans between 40 and 60%, and monetary saves between 40 and 60%. On this basis, let us estimate the orders of magnitude for neutralizing public debt in billions of euros at the European level and then at the French national level. To carry out the calculations, we will use the monetary aggregates in the Eurozone and France in 2018. It is these outstanding amounts that will serve as the basis for the calculations in the following tables. Let us estimate the order of magnitude of the amount in billions of euros of the full coverage of sight deposits and assimilated deposits transferable to the MIC in the European framework in 2018. Overnight deposits are fully transferable. That is 7,115 billion euros. Deposits with fixed maturities of up to 2 years for the base band represent 20% of 1,028 billion euros. That is 285 billion euros. For the high band, 30% of 1,128 billion euros. That is 338.4 billion euros. For deposits redeemable at notice up to 3 months. 20% of €2,298 billion. That is €459.6 billion for the low and high bands. 40% of €2,298 billion. That is €919.2 billion. For interbank loans. 40% of €75 billion. That is €30 billion. And for the high end, 75% of €75 billion. That is €45 billion. For UCITS and debt securities up to 2 years. 40% of €596 billion. That is €238.4 billion. 60% of €596 billion. That is €357.6 billion for the upper range. Let us add all this up and we find, for the low range of currency needed for the transfer, €7,609 billion. For the high end, €8,775.2 billion. Let us look at the general government gross debt of the 28 members of the European Union in 2018. This gives us €12,772.272 billion of debt. What would be the neutralization of European public debt? For the lower range, more than 59%. 59% neutralization for the low range of European public debt. For the high range, around 69% neutralization of European public debt. Let us estimate the order of magnitude of the amount in billions of euros of the full coverage of sight deposits and similar deposits that are transferable to the MIC. But this time at the national level. As before, sight deposits are 100% transferable for a total of €1,017 billion. Term deposits with fixed maturities of up to 2 years. Between 20 and 30% of €114 billion. For the low band €22.8 billion and for the high band €34.2 billion. For deposits redeemable at notice of up to 3 months. This represents €135.6 billion for the low band, and €271.2 billion for the high band. 8.8 billion for the low band, and 13.2 billion for the high band. For UCITS and debt securities up to 2 years. €132.2 billion for the low band, and €180.8 billion for the high band. To sum up, a total for the required amount in billions of euro of sight deposits transferable to the EMC of €1,316.2 billion for the low band, and €1,533.6 billion for the high band. Let us look at French public debt. In 2018, it was about €2,301 billion. We can therefore neutralize more than 57% of the French public debt for the low range. If we place ourselves at the high end of the range, more than 66% of French public debt, 2/3. Let us look at how the 100% money system works in the European framework. First of all, X billion euros of central bank money is issued by the ECB, or the MIC to cover sight deposit accounts and similar accounts. On the balance sheet of the MIC or the ECB, there is, for the assets, the monetization of uncovered sight deposits and similar. On the liabilities side, there is the central bank money owed to commercial banks to cover uncovered overnight deposits. Let us now look at the balance sheet of commercial banks. On their assets side, the X billion euros of central bank money exchanged by the MIC or the ECB. On the liabilities side, the X billion of government bonds ceded to the MIC or the ECB. These X billion euros of government bonds will then be given to euro area member states to neutralize a large part of their national public debt. How to set up 100% money in the national framework? The functioning would be almost the same as in the European framework, with the only difference that it is the MIC that manages the issuance of currency and the exchange against government bonds. The MIC issues these X billion euros of central bank currency to cover sight deposit accounts and similar accounts. The balance sheet, as we have seen previously, of the MIC is, on the asset side, the monetization of the X billion euros of sight deposits and similar deposits not covered before the transition to 100% money. On the liability side, the central bank currency owed to commercial banks to fill the uncovered sight deposit accounts. The balance sheet of the commercial banks remains unchanged compared to that in the European framework. On the asset side of the bank's balance sheets, there are still the X billion euros of central bank currency of the MIC, and on the liability side, the X billion euros of government bonds transferred to the MIC. This is only a transit. These X billion euros of bonds go to the French government to neutralize its public debt. How can commercial banks be convinced of the usefulness of switching to 100% money? First of all, it is an asset in the sense that the race for liquidity to reinforce reserve requirements is over, since sight deposit accounts are fully covered with real currency. For the banking sector, it is an insurance against the risks of illiquidity and insolvency in the event of a massive withdrawal of depositors. But this guarantee comes at a price: the free management of depositors' accounts. For example, in the event of refusal by some banks, another system could be envisaged with a superbank public platform for managing the current accounts of all commercial banks. What would happen if a commercial bank refused to enter the 100% money system? In other words, how would it be possible to encourage this bank to join the system? A law promulgated by the European Commission in agreement with the ECB could oblige the bank to apply 100% money. The guarantee of 100,000 euros from the state per person and per banking institution would be taken away from any commercial bank that does not want to enter the new system. It is clear that, informed, the customers of this bank would surely choose another commercial bank, where their deposits would be fully covered.